Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And today on the podcast, we're wrapping up August. We're into September now. I was always here, but experience has taught me that the cadence of business in August is very slow in the financial markets. It seems the longer I'm in this business, the slower it gets. And so I've discovered that posting lots of podcast and blog posts in August is usually not a very productive endeavor. The number of people who look at it is much smaller, and so content kind of gets lost. I've also been working on some neat projects in August that has taken me away from doing some of these regular podcasts as well. But we're back from August. We're into the fall, and it's going to be a very interesting couple of months coming up here in the United States and by extension, the rest of the world. Let me give you a little roadmap about where we're going with this podcast. Today we're going to clean up some old stories that I didn't get to in August. There's always, there are a lot of little stories that come up from time to time that it feels like I should say something about them, but it's not going to be a full podcast. It'll take me a few minutes to talk about, and it doesn't really fit into other podcasts. And so they sort of sit there and languish. And so every once in a while, I'll put out one of these podcasts where we kind of catch up and go through some of the important inflation-related stories. And we're going to do that today. And then over the next couple of weeks, we're going to get into – next week, of course, is CPI. But then we're going to I'm going to have a podcast on real feel inflation, which is about how to think about how inflation feels and why it doesn't feel the same as the way we measure it. Based on some work I've done in the past, I'm going to do a podcast on the longer term effects of inflation on institutions and households, and then one on the role of inflation-linked bonds in portfolio construction. Probably will have a guest along the way here. But before we get into today and some of these stories, I want to make sure I give a nod to our sponsor. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. So before I get into sort of the other stories by other people that I want to talk about, I want to first do some cross-pollination. As you know, I've got a blog and I have the podcast. And so I try to occasionally tell listeners on the podcast, hey, go look at the blog. Well, I do that at the end of every episode, but and I tell the people on the blog to go listen to the podcast. And generally, it's mostly different content. Occasionally, there'll be some topic that is, I wrote a blog that's so great I want to talk about it on the podcast, or I did a podcast that's so great I want to write about it on the blog. And although I'm not going to do an episode on this necessarily, the most recent blog post that is linked in the show notes, it's called A Price-Linked USD, is worth your consideration. It's worth reading if you haven't read it. And again, it's inflationguy.blog, and the article is A Price-Linked USD. And I think it's interesting because it's related to a project that I've been working on, but I kind of go back to a particular currency, and it's a non-traded currency, but it's a very special and unusual currency called the Unidad de Fomento, it's a Chilean currency that was developed in 1967 as a way for the Chilean government to encourage, contracts and people, and encouraging people to actually make contracts in an era when inflation was so high and so variable that it made long-term contracts very difficult. If you think about it, if inflation is in the U.S., we haven't, until recently, we hadn't had a taste of this. But when we went through a period of very low and stable inflation, it's very easy to kind of come to a reasonable, a long-term contract, because both sides, have opposite inflation exposures, but they both view the inflation exposure as low, right? If let's suppose it's a labor contract, and I, the worker, I obviously want to fight for the highest nominal increase in wages that I can, because I don't know what inflation is going to be. And so I want to make sure I get enough. I don't want to argue for a 2% wage increase and then find out inflation was 5%, right? So I'm going to argue for the higher wage increase. And on the other side, the auto manufacturer wants to pay a lower nominal wage because he doesn't know that he's going to be able to raise car prices. If he thinks he can raise them 5% and it turns out inflation is 0, then that's going to be a problem. And so he has the opposite exposure. But if we both assume that inflation is roughly 2%, then that doesn't cause a big problem. It means we can't. It means the longer the contract goes on, the more risk we both have, and so you don't tend to have 10-year contracts when you have, an offsetting risk like that. But anyway, the unidad de fomento was a currency that in a very high and variable inflation environment in the late 60s and the 70s for Chile, allowed, essentially was a unit. It was a price-adjusted Chilean currency that allowed people to contract in that currency, that basically said, okay, we're going to, if I pay you 1 UF today, I want to get in real terms 2 UF 3 years from now. But what that UF is worth in terms of the actual currency is determined by the inflation rate. And so it's actually, the UF adjusts with the price level. Anyway, this is a very long summary. The summary is longer than the article. But the article kind of talks about how useful that would be in U.S. dollar terms. But anyway, it's a good article and worth reading. And it's actually probably, like I said, shorter than my summary was just then. But it's very exciting. It's a very interesting topic. When you think about it, our entire world is based in nominal space. We've all learned to think in nominal space. And when inflation is low and stable, that doesn't really hurt us that much. When inflation starts to be variable, then it really pays to be able to think in real terms and ideally to be able to contract in real terms so that you don't have to have that exposure. And I think I've talked about this in the context of insurance rates and things like that. But anyway, let me get back to the topic, which is some of the notes that I've made and some of the articles that I've read that I want to talk about. One more observation before I get into actual articles, but one more observation that I've read a lot recently as inflation has been coming down, and the Federal Reserve at the end of this month, the end of September, is going to almost certainly ease, drop interest rates 25 basis points, maybe 50 basis points. As I've been saying, as a lot of people have been saying for the last couple of months, was going to happen, and so that has produced some reasonable observations from the punditry that, Arthur Burns, a Federal Reserve chairman in the 1970s, famously made multiple policy errors, but when, after seeing inflation coming down, he believed that inflation was licked, eased too much and too soon, and inflation headed right back up and And so there was three peaks in inflation in the 70s and early 80s, mostly because of Arthur Burns. And so people have started to ask, and it's a reasonable question, whether the Federal Reserve easing now when inflation is at 3 or 4%, depending on whether you're looking at core CPI or sticky prices CPI or median CPI or what have you, inflation is still well above the Fed's target. They believe it's coming down, but it isn't at target yet. Is Powell becoming an Arthur Burns instead of becoming a Paul Volcker? And it's a reasonable question. And I think it gives us something of a framework, of way to think about the next couple of years. Because when Burns made his mistake, inflation didn't turn around and head immediately higher, right? It took a little while for those mistakes to manifest. And so where the way this sort of fits into what I think the trajectory is, I've been saying for a long time, we'll end up with median inflation in the high 3s, low 4s. We'll initially go a little bit below that, probably because of rents, but that's where we're going to kind of end up, I think. And in fact, when you go to 2025, I don't see inflation being having a lot of upside risk, other than if gasoline, if we really get if the hot war in the Middle East gets hotter, and energy prices go crazy, then you could obviously get higher headline figures. But I do think that because rents are declining, and they're going to decline for a little while here, that's going to keep overall inflation from just sort of spiking right away again, even if there's policy error today. However, again, looking at sort of the 70s, once rents have made sort of their full round trip in terms of the rate of increase, and that'll be sometime in late fourth quarter of this year, or the fourth quarter of this year, or early part of next year, then you start to be in a zone where you can see those errors begin to manifest. We'll have a recession. We're probably either in a recession or about to be in one now, and that's going to sort of keep energy prices a little lower. It's going to dampen some things, but then once we come out of things, when the economy recovers from this recession, if the Fed stops shrinking its balance sheet soon because of the recession, then what's going to happen is in late 25, early 26, as the economy recovers from the recession, then much more quickly we're going to get an inflation outcome, right? We're not going to. It will confuse the heck out of policymakers, because we won't need to be back at full employment before you see inflation. That's the way policymakers think about this. If we have 3% unemployment, we need to worry about inflation, but at 5% unemployment, we don't have to worry about inflation. That's not the way inflation works. Inflation doesn't follow wages. Wages follow inflation, but it's going to confuse the heck out of them. In late 25 or 26, if the Fed makes this policy mistake, if they stop shrinking the balance sheet, if they let money supply growth go back up, then what's going to happen is, as we're just starting to recover from the recession, we're going to see inflation suddenly start to go higher. I don't think it'll go up to like 8 or 9 again, but it'll be a lot higher than we've seen, with the exception of that spike, for 30 or 40 years, right? So it's going to go back up to 5, 6, something like that, maybe. Anyway, I don't know exactly what the trajectory will look like, but I guess the warning here is that the Arthur Burns map says that even when the Fed makes a policy error, it does not immediately affect inflation and prices, but it does get there pretty quickly. And the policy error is not fully stamping on, and frankly, recognizing that money supply growth needs to be lower in the current economic environment, given that we have demographic challenges pushing inflation higher and deglobalization pushing inflation higher. And so therefore money supply growth, all else equal, needs to be lower than it historically has been. That's sort of the error that when the Fed stops shrinking its balance sheet, they need to still keep a good eye on what's happening there. And I suspect they will make that error. Anyhow, let's get to some of the stories that have been on my to-do list here. There was one on, and by the way, the links to all these stories are in the show notes. There was one on August 25th in the Wall Street Journal that I thought was really interesting. It was called Pay Your Rent, Get 2% Cash Back. Landlords Join Craze for Rewards. And the idea was that landlords and a couple of companies have sort of offer these programs to landlords to allow the landlords to offer special bonuses to their tenants who pay rent. And they're loyalty rewards, just the same way that an airline offers you miles or points for flying on their airline. What does that do to you, the customer? Well, it tends to make you stickier. If you have lots and lots of United miles and you accumulate lots of United miles, then you're more likely, all else equal, to continue to fly on United and accumulate more miles rather than fly on Delta, where you don't have any loyalty points in it or a loyalty program. And that's what I would expect to have happen if this gets to be at all widespread. You're going to get stickier renters, right? All else being equal. Gee, I'd like to move, but I've got all these loyalty points. I've got this cash coming back at the end of the year, and credit for future wallpaper or whatever, or whatever. That's going to tend to make people a little stickier. And if that's the case, then that would mean that the rent indices, the shorter term rent indices, the NTRR, the faster twitch measures of rent inflation are going to become even less representative than they are. There's a whole lot of reasons why those faster indices are exaggerating how much of a disinflation or deflation we'll see in rents, and they have exaggerated, and they'll continue to exaggerate it, and for some kind of systematic reasons that I've talked about before. But the point is that if renters become stickier, then they're going to be even more wrong, right? Stickier renters also will tend to tolerate more rent increases. So if you are not a new renter, you haven't moved, and you stay where you are, you're more likely to be paying to see your rent go up more because you're loyal than if you were competing and you went to find a new rent somewhere else. So the important point here is that the economic system is always changing in all these different product markets, and that's why a broad sample like the BLS takes with rents that covers both renters who are continuing to rent and new renters. That survey is less likely to be influenced by things which affect one part of the market more than other parts of the market. And so, but I think it's a fascinating development, and probably all else equal tends to make rent inflation a little bit higher. There were a couple stories in late July, early August that I'd characterize as supply chain stories. One of them is it was in an online blog called Utility Dive on July 31st. PJM capacity prices hit record highs, sending build signal to generators. And I'll just read a couple of their bullets here. I think I'll summarize some of the. Anyway, so PJM, the PJM region. So PJM is a broker of energy capacity, and for the majority of the PJM region, which includes like Maryland, Virginia, North Carolina, for the majority of the PJM region, capacity prices for the 2025-26 delivery year soared to $270 per megawatt day, up from $29 a megawatt day in the last auction. So that's like almost 10 times, right? That's like nine times higher. Prices hit zonal caps of $466 per megawatt day for the Baltimore Gas and Electric Zone and $444 per megawatt day for the Dominion Zone in Virginia and North Carolina. The auction's total cost to consumers jumped to $14.7 billion from $2.2 billion in the last auction. So a massive, massive increase. The spike in capacity prices was driven by power plant retirements, increased load, and new market rules that aim to better reflect risks from extreme weather, coupled with new resource accreditation metrics that are designed to reflect how much capacity a resource delivers during system stresses. So the long and the short of that is, the economy. This is where a recession helps a little bit. Right? If you put a little bit less pressure on the grid, on the generation capacity, but the bigger point, I guess, is that it's difficult to build power plants quickly. It's difficult to bring new capacity online very quickly, and this is likely to be something that going forward over the next 5 to 10 years, the energy costs, the cost of electricity as opposed to crude oil and let's say dirtier forms of energy are likely to be higher. The costs for that are likely to be higher, and that's partly because of the drive for electric cars, for the use of generation capacity for cryptocurrency calculations and things like that. I mean, the demand on the grid is going up faster than the general rise in the GDP, and capacity is having trouble keeping up. So that's something to keep in mind. That is a supply chain kind of issue that is going to get us in the next swing higher. We also have sort of a return to the shipping issues at some level. So there's a story in Reuters. I didn't note like this. I guess this was from mid-July. U.S. importers balk at return of $10,000 container shipping rates. So there's been a surge in shipping rates and a shortage of containers, and a surge in the length of time that a container has to be on the water in order to get to where it's going. But this is happening partly because of the fear of new tariffs after the election. So the idea is, rather than waiting, until you get closer to the holidays to go in, if you're a retailer and you've got to bring in goods, get them on the water early, partly because lead times, shipping times it's taking longer, but also because if there are tariffs implemented and your stuff's already here, you don't have to worry about the tariffs. And so get as much of it in as fast as you can. And what that's doing is putting a lot of pressure on the shipping lines where there's already some tightness in the container market because some of the routes are still screwed up. The route through the Panama Canal and through the Red Sea for different reasons are gummed up, and which means that the average shipping the average container ship has to be on the water longer. And so lead times are longer. And again, this is a supply chain story, and not as bad as the pandemic, but, shipping costs recently, I guess in August, got up to around 2/3 of the pandemic high, down a little bit from that now. But, the cost of a container from, say, Shanghai to L.A., or India to New York, went up to about 2/3 of the pandemic high. And also, as I said, the length of time needed to get the container from point A to point B. Not as bad as the pandemic, but it's a reminder that the shipping ecosystem, like the power system, remains fragile. And that leads to the next point. Remember that supply chain problems are not just a function of the brittle supply chain. They're also demand. Demand plays a role, okay? And it's demand pushing on that brittle system. In the pandemic, the problem wasn't that they supply, supply chains were all, the quantity supplied. It was just much harder for people to supply any amount of goods and services. Although that was more difficult because of all the COVID rules and smaller workforces and so on. Definitely had a supply constraint. The problem was, that always happens though in every recession, right? Every recession we lay off people, we have fewer workers, we produce less. What was different in the pandemic was that governments, central banks, legislatures refused to let demand also go down. And so there was a mismatch that we had, the national income, even though GDP took a deep, deep dip, the national income did not take nearly as much of a dip because there were massive transfers from the government. That was what caused the problem, was the demand, which didn't go down, pushing on a fragile supply chain that did have capacity issues. So again, normally when you think about a supply shock, you think about the locusts ate all of the coffee beans in Brazil. Okay, so that suddenly you have no coffee beans. That's a supply shock. What we saw in the pandemic, what we are starting to see here, isn't so much a supply shock. It is, and by the way, most of this will probably hit after the recession. We were heading back up. It's the problem is an increase in demand, especially if artificially stimulated by legislatures and central banks, that demand pushing on supply, which is not as responsive. Finally, in the be careful what you wish for category, there's a story from July 29th. It was all over. In the New York Times, there was an article called Japan Wanted Higher Inflation. It's here and it hurts. Be careful what you wish for. According to the story, the Bank of Japan welcomed the increase in inflation that was happening during COVID and after COVID, I guess, as a way to boost the economy, inflation boosting the economy. And it was worse because they didn't just sort of welcome it, but they actually worked to boost it, not just with monetary policy, but by things like having the Ministry of Investment, Trade, and Industry, MITI, try to persuade businesses that it's patriotic to raise prices, and in general, trying to convince everybody that it's good to see inflation, and so you should really want to pay higher prices. It's good for everybody. That's obviously bananas. The Japanese economy has been doing just fine for quite a while. It just, it looks sluggish because prices haven't gone up a whole heck of a lot, but that's not a bad thing. Stable prices is not a bad thing. Low inflation is not a sign of malaise. In this case, it was a sign of sluggish money supply growth that the Bank of Japan had for a very long time kept money supply growth very, very low. And guess what? That leads to very, very low inflation. Now, there was a brief period where the Bank of Japan tried to increase money supply growth aggressively and did for a little bit. Inflation started to go back up. This was all pre-COVID. And then suddenly they decided that wasn't a good idea. And they were just going to go to the zero interest rate policy, ZIRP, instead of trying to grow the money supply. And guess what? Inflation fell back down. But again, this isn't really a problem. The crazy thing is trying to convince people that inflation is good. Workers know it's not good. Consumers know inflation is not good. The astonishing thing is central bankers appear to be less clear on the subject, that inflation is not good. If you don't like how good your economic growth is, the answer is not try to produce more inflation. That is going to produce the opposite effect. Anyway, so we're done with August. We're done. That's most of the stories that I'd been sitting on that I thought were worth a comment. There are all kinds of crazy things happening, but some of them just don't deserve comment. These were things that were short things that didn't really fit anywhere. As I said earlier, coming up after CPI, I've got podcasts planned on real feel inflation, on the longer term effects of inflation on institutions and households. Stuff Japan should have thought about. And on the role of inflation-linked bonds in portfolio construction. Speaking of which, actually, inflation-linked bonds right now, as I the last couple of days, and we're getting the employment number tomorrow, and this could all change, but, nominal rates have been declining, but real rates, tips rates, have been going up because people are so convinced that there's going to be, huge disinflation that that longer-term real rates are rising, which is, again, if you're heading into a recession, you should see real rates declining and nominal rates you don't know about. It is unclear depending on what happens to inflation. So strange things happening. Our model has tips about 45 basis points cheap right now. Yields about 45 basis points below where they, above where they should be, given where the level of nominal rates are. But anyhow, strange times. And we're getting into the fall. It's going to be a crazy couple of months. Ought to be interesting. I hope you had a great summer, and I hope that you make time this fall to come back and listen to this podcast, review the blog. Good luck, and I will see you on the flip side. Please like, subscribe, refer others. You can contact me at inflationguy@enduringinvestments.com and subscribe for free to the blog at inflationguy.blog. Visit Enduring Investments if you need help with diagnosing or treating an inflation problem, and most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.